Well, good afternoon, investors. Welcome to the two-day delayed August 4th, which should have been August 2nd edition of Bull Sessions. My name is Mark Robertson. I'm joined here by Ken Kavula, and there are a couple other people in the audience who we've been chatting with. Again, sorry about starting a couple of minutes late, but because of the new date, we appreciate your patience and consideration. And we'll get underway. We do have a fairly full plate today. Do want to talk a little bit about my day spent at the polling place as an inspector, just a tiny bit. And Ken and I will be with the audience, not face to face, but we have a webcast that'll go off on Saturday morning where we will be leaning a little bit on that notion of the chasm, which, Ken, as you recall, we talked about right at the start of the COVID meltdown. Good afternoon, sir. How are you?
I'm here, Mark. Okay, and
I know you're.
yes, I thought it was a good presentation at the time, and I think it's very germane at this particular point in time as well.
Yeah, and when people ask me, about that type of general theme right now, I really do think that if you select stocks carefully, as we all do, or we all strive to do, it's time to be picking those stocks that 5 years from now you're going to be able to look back and say, 5 years ago I picked that stock and this is what happened. Generally with a smile on your face. So I think that's kind of the mode we're in. We hope to treat that subject faithfully on Saturday morning. Go ahead.
I will tell you that I've been very interested in certain industries where PE values have been just beaten over the head with a hammer and have moved down to what I consider extremely low averages for the industry. And I'll be identifying half dozen different industries and maybe a few companies from a few of those industries that are that the bar is set so low for right now that they can probably afford to do virtually nothing in the way of growth and still beat the expectations that the market is holding for those companies right now. So I think there'll be. I don't normally invest like this. I don't normally look for the best bargain that I can find, but I think this is an opportune time to do a little bit of sifting through the numbers and trying to find companies that are selling at ridiculous valuations right now and that you might like to own for the next 5, 7, 8, 9, 10 years.
Absolutely. So we will be checking in at halftime at the Groundhog. Our current leader is Sean Mace there in the Lederhosen on the banner at the bottom of the page. And we will continue our S-curve studies of a couple of companies, checking in on Hershey's and Fossil. And then we're also going to turn the page a little bit on Facebook, which is now Meta Platforms, and just pondering the question, are they having an existential moment? I'm usually pretty skeptical about existential moments, but I think this one's worth scratching our head over as they face some fairly interesting challenges, and if nothing else, we launch a bit of a debate. Anything else on that, Ken, or should we get underway?
I think we're ready to get underway, Mark.
All right. We do have a number of slides to get through. A lot of familiar faces in the audience, but if you are a newcomer, and even if you are a familiar face, no investment recommendation is intended by anything that we do here. This is all about an educational demonstration of the principles, philosophies, and analytical methods of the modern investment club movement as we have interpreted them here at Manifest Investing. So these are our opinions, but we are basically attempting to deploy and demonstrate stuff that has worked for nearly 8 decades now, leading people to some fairly decent measures of success in investing. And that's what we're trying to basically lay out for in an illustrative manner. Please do your own homework, though, before making any decision. And we might actually hold something in our portfolios, and we'll try to remember to let you know that. We do a monthly webcast called The Roundtable. It's basically an hour and 15-minute program once a month, last Tuesday of every month, generally 8:30 Eastern time, where we go through this type of a process for 4 or 5 of our favorite investment opportunities to study at that point in time. If you want to be on an email list about that particular web event, send an email to ncavula1@comcast.net and simply ask Natalie to add you to the reminder list. If you have any follow-up questions or would like copies of the slides or have suggestions for future topics, our 2 email addresses are on display there at the bottom of the page. All right. So here's a quick moment. This is the reason we're meeting here today on Thursday rather than Tuesday. This is what I did all day Tuesday. And I know a number of you have probably served in this capacity also, volunteered, ended up as an election inspector here in the state of Michigan for our primaries, which meant that I had to roll out of bed at 4:30 in the morning and that I was actually on duty until nearly midnight. Quite a long day, but a wonderful day. If you ever have the opportunity to do this, I would strongly suggest you consider doing it, volunteering through your local precinct or offices. I worked with a fantastic team all day long. And one of the more noticeable things is voters are friendly people. People who come out to the poll are friendly. The process was thorough, and I would call it airtight. For those of you out there wondering about the quality and security of elections, at least in the precinct I served in, it was absolutely airtight with some top-notch people manning the stations, and again, just a wonderful experience overall. And Ken, have you ever done anything like this, or have any friends that have?
I've actually served a couple different times, Mark, and my experiences were very much the same as yours. It's a wonderful exercise in feeling good about helping out in a very important kind of a position where they're always searching and needing volunteers. So it's they'll train you, they'll feed you, they'll work you really hard, but at the end of the day, you'll have a really good feeling about what you did and why you did it.
All right, so let's go ahead and press on. Just a moment for that. Here's our almost weekly presentation of the market as measured by the stocks in the value line standard edition. Those are the green bars, basically an index built of those stock prices. The red fluctuating line is basically an average of the return forecasts on those stocks. And you can see that it's dipped down a little bit because the market actually has gone up quite a bit over the last month. And, well, actually the last few days, really. And the green bar is back touching the blue line. So interesting times in the stock market. The blue trend is simply a mathematical trend through the points. And Ken, it's just not a straight line from A to B there. It's kind of a zigzag along the way. We just have to accept that.
We'll point out that growth on a normal scale, like you used to graph on in grade school, growth on a normal scale graphs as a parabola, and that's the name of that blue curve right there. If we were to put that on that funny kind of graph paper that we use for viewing and evaluating a stock, it's called logarithmic graph paper, and growth there graphs as a straight line. I'm intrigued by this particular graph, Mark, because I'm trying to capture these and put these almost into an animation, if you will. And I've been watching this green bar ever since July 1st. It was quite a ways away from that blue line on July 1st.
Indeed.
And it's just been moving ever so steadily and slowly up to that blue line. And it's now closed that white gap that we notice occurs sometimes when the stock market is taking a timeout or when the economy is signaling some various things. I'm not quite sure if that gap is closed for good, but it's certainly closed at the moment, and that's heartening to me, at least. It says that maybe this period of time that we're trying to get through with everybody arguing about, are we in recession, are we not in recession, and everybody talking about a soft landing. Maybe in fact the Fed is going to be able to manufacture that soft landing, and maybe in fact the market is beginning to sense that and is looking ahead as it always does, and therefore deciding that we don't need any kind of a major recession to get things sorted out.
Absolutely. And we'll probably be talking about recession on Saturday a little bit. All right, here's a real life example of that same thing, Tin Cup. We'll talk about Tin Cup for just a minute. That's a model portfolio emulating a hypothetical effort to maximize the investment in a retirement plan at work, a 401k, for example. Investing in common stocks since 1994, you can see that we reached up to almost 4.5 million, have settled back here with the disruption in the stock market over the last several months. But July was a good month, almost up 10%. The general stock market gained almost the same at 9.4 that you see down here below. That's one of the best months since 2012. And looking at the 5-year trailing annualized total return for Tin Cup, we're looking at 15.4% versus 12 for the Wilshire 5000. But even more compelling from where I sit, that 15.4 versus the value line arithmetic average, because again, we regard that as a better index of all of the above investing, that being large, medium, and small companies. So to be 6.1% ahead of that is doing pretty well. So,
Mark, can I break in for a moment?
I've
I've been lying to people on the website here. I've been telling them that there's a link under events on the Manifest site to our Saturday presentation. Will you promise me that you'll put a link there as soon as we're done so that people can register for the Indianapolis event then?
I will do that. I promise.
Okay. So John and Barbara and Ann and Jennifer, all of you, Mark says he will do that at the end of the presentation. Give until maybe 4:30, but it'll be there, and then you'll be able to register for that event. Thanks, Mark.
My apologies. In addition to elections, I have a number of other things that are a distraction.
I understand how full your plate is, and I marvel at you getting even half the things done that you get done, Mark. So,
well, thanks. Well, let's talk about something else that we did get done. Tin Cup, the decisions made this month in the portfolio, and this one actually wrecks my heart because Boston Beer is a personal favorite. What you're looking at here are the actual holdings of the Tin Cup model portfolio or demonstration portfolio. They are sorted from highest return forecast to the lowest, which means that anytime the portfolio average down here, you see it at 15.6, is less than a 5 percentage point advantage to the market, which right now is at 11. So we want to see 16 there. So Boston Beer is on the hot seat. Boston Beer is on the hot seat. And for that matter, the ones up at the top can be subjected to the hot seat. The only other editorial comment I'll make at this point is there's quite a bit of semiconductor in here. So that's been holding us back. Hopefully that will help launch us going forward. But before we do that,
I'll just add my 2 cents, Mark. I'd like to see you submit Axos Financial to the hot seat as well. I just the more you read, the more you have some issues in your mind, at least, about what Axos is accomplishing or trying to accomplish. So I'll just add that to your list and then let you make the final decision. This is your portfolio, but I've unloaded Axos from the portfolios that I own, and I've never looked back after I've sold it. So.
Yeah, and I have done some of the same thing. We do try to keep this portfolio very mechanical and as unemotional as we can get, but if we have reason to suspect that the growth projections or if we believe that we're not hearing the truth, that may or may not be the case. It can be enough reason to jettison a company. because a company that you no longer can trust, the PE can actually go to zero, and that's never a good thing. All right, we'll do that, Ken. But here's a quick timeout. A year ago, well, actually 2 years ago, we started a horse race between Ken and me. And a year ago, First Financial had actually beaten Great Southern Bank Corp. We both attempted to pick a company 2 years ago, a bank 2 years ago. These were two personal favorites. And Ken, you won the run for the roses on the first leg last year. But between then and now, I just have to say scoreboard, man.
Well, I don't mind making 24% on any stock. I don't care if it comes in second place or 10th place or 20th place. If it's going to give me 24% total return and beat the market by 11, I'm going to take it. So I graciously bow to you as the winner of the second leg right here, but I'm not going to move away from First Financial. I still think it's a wonderfully managed bank, and it's going to stay in my portfolios.
Well, these have been so rewarding, and we'll probably do a special bank session in the not too distant future. But pretty nice, and of course, I have a nice lead going into the third leg, so we'll allow that to happen too, since I am, after all, the
I
scorekeeper.
will. I will also tell you, Mark, that I do own Great Southern in one account as well. So I haven't forgotten it, and I haven't overlooked it. It's another one of the half dozen or so banks that I consider to be cream of the crop.
And I guess the only other thing I would share with the audience, because I know many of you struggle with investing in financial sector companies, this should actually tug at you a little bit when you see this type of performance. Now, that's not any guarantee about what might happen over the next few years, but the point is, from time to time, there are some wonderful opportunities amongst the banks and insurance companies.
Well, and it's especially uh, interesting is a good word, I guess. It's especially interesting when you consider that for most of the 2 years here, there have been virtually no interest rates of any kind.
Mm.
They've been so low that they might as well be regarded as zero. They're just now moving towards, I think at the last press conference that the Fed chair had, he suggested that they might be at break-even stage with interest rates. But there's a lot of dispute about that number even. So I think that a well-managed regional bank probably belongs in almost every single portfolio, and we're giving you the tools and the information to find them. And there's a number of them. There's at least a half dozen of them that are extremely well managed, and that's just in the small sample that I've gone through one by one by one. I'm sure we can come up with another dozen if we really worked at it.
And we will work at it and do that. All right,
Okay.
back to Tin Cup. Here's a quick look at Boston Beer. I do think it has been shaken, not stirred, shaken. Here with the stuff that's gone on in 2021 and part of 2022. If I'm holding that in a personal portfolio, maybe I hang on and hope for a recovery back to the lines as you're seeing up here. These are the analyst projections for this year and going forward. If that happens, the price recovery could be pretty steep. In fact, it has been steep. It's gone from 310-ish up to 380-ish in a relatively short amount of time here recently, and there could be substantial price recovery. However, in this case, we are talking about the mechanical aspects of portfolio management and basically shedding a company with a relatively low return forecast. And again, the thing to be watching is, does this happen in a way pictured here, or do they actually come up short? Because that will hold this company back for some time to come. So if I own it, I probably hang on to it and hope that they deliver as good or better versus those forecasts you see on the right. But in this case, we will sell it from the Tin Cup portfolio and replace it with one of these. And this is a stock screen at Manifest Investing. We are using a simple one using the triple play the sweet spot. So that means that the par is going to be between 16 and 21. And I did want to keep the growth strong in the overall portfolio. So here's your list. Anything semiconductor is not eligible. MKSI is basically a semiconductor stock in that they serve the semiconductor industry. So that leads us to installed building products. And decent quality, good quality, not great quality, but good quality, and a good return forecast. It's unlike anything else that's in the portfolio. By the way, Google's the #1 position in the portfolio, so that one comes out. This might be a good study. Any awareness of this company, Ken?
No, I'm looking at it and I'm jotting it down right now. Go
I mean,
easy.
it's
It sounds to me like it's oh, it is. It's on the Toronto Stock Exchange.to. Okay.
it might be early stage, but it could be worth a look. Floor and Decor actually rhymes with installed building products a little bit. And
I happen to own Installed Building Products and Floor and Decor, both, Mark.
mhm.
I own them for different reasons. Installed Building Products is a play on the new infrastructure bill that is gradually going to start to be funded across the country. They do pretty large projects a lot of times. Floor and Decor is more of a play on a Home Depot like company that will be talking to people that are finding they don't want to move or they can't move for one reason or another, and therefore they want to make their home a little bit more livable. Both stores have great studies, great SSGs, and both stores have been, in my mind at least, on sale for the last 4, 5, 6 months.
Yeah, and I'm pretty sure that installed building products is pretty diverse. They actually also make things like garage doors and gutters and all the stuff that goes with finishing off homes and buildings. And
Well, they make a lot of products that go into larger structures than just single family homes too, Mark. They'll do a lot of work with uh, actual, multi-story buildings that would have huge contracts attached to them for all of the blank, whatever it happens to be, for the entire building. So it has a lot of scale to it. A very interesting company to do a little bit of study on and to read, and as you say, extremely diverse.
yeah, and I'm a bit mystified by the amount of commercial and industrial construction that I see. Uh, there's an awful lot of empty office buildings out there, and people are returning from remote working, but it'll just be interesting to see what lies ahead. There is that element of uncertainty here. There is a shortage in residential inventory, so that's a positive here. But you see the expectations for operating margins are pretty steady, as are the profitability, a little bit flat on the earnings side, but it'll be interesting to watch. This is a living demonstration of scalability of a business also in terms of these improving margins over time. And I'll ask you to contrast that completely with what we put up here in a few minutes for companies like Fossil as we discuss what went on there. But again, you're looking at a decent growth forecast of 12% or so, decent net margins of 7-ish, which you can certainly believe looking at that picture on the right. And again, not an exorbitant PE, so it's an attractive return forecast, and it will be added to the 10-cup portfolio. Pretty decent other characteristics too.
I think excellent ad, Mark.
All right, so here's the ad, and we do end up at 16.5, so our work is done here. So again, that's the result of selling, and I'm crying in my beer here, Sam Adams Boston Beer, and replacing it with boring, stodgy construction supplies and equipment company. But we're up to 16.5, as you can see there, so we can press on. All right, so let's take a moment just to say it is halftime in the Groundhog Contest. I put the top 50 up here. Sean Mace is clinging to #1. He is the only individual participant above $1 million at this point. We did have a couple a few days ago, and there's a few of you floating right around that $1 million threshold. David Einhorn still leads the celebrity hogs, and we do have a kind of a new group entry, the Bermuda Triangle, sneaking up the top there. But there's a number of very interesting people. I will tell you that there was a guy doing cartwheels a few minutes ago. This because he's ahead of this guy down here now. He has a thing. He has a thing about the monkey. What else? How else does this speak to you, Ken?
Well, I'm really happy, Mark, to see returns over on the right-hand side that are positive for at least a group of 25, 30 people. And there's been a number of years in my long investing career when I would have taken 3.5% and run for the hills. So I don't regard that as wonderful, but I certainly regard 3.5% relative return as something that I've seen before. It's not an outlier. And I appreciate the fact that my portfolio has moved positive. I always thought that as we moved from extreme negativity to maybe a more neutral stance, that the portfolio that I entered would move up the list. I didn't expect to move as fast up the list as it did. This move from spot, 75 or 80 up to spot 19, and it did it in about 3 weeks. So I'm very pleased with that. And watch out, top 10, here it comes, okay?
So are you suggesting there's hope for me too, or?
I don't know where yours is, Mark. I can't find yours. I didn't go down the list far enough, I guess.
As they say in the newspaper business, I'm clearly below the fold.
Okay.
The other hands or cartwheels that we had last week was from Nick DiVirgilio. He's been moving up. He was down around 30ish or 40th, and he's moved up. And of course, our dear friend Sean. Now Herb is just lurking at number 5 there. With a very nice defensive portfolio at just the right time.
And I think that defensive portfolio is going to stay around as a great portfolio for another half dozen months at least. I don't think it's the time to be running away from your defensive stocks. So Herb, my hat is off to you. That was a well thought out group of stocks in February. Very well thought out group of stocks.
I would also point out that our two defending group champions are 47 and 48 there, so they're not exactly out of it at this point. And as Kay Light likes to point out, it's still early. All right, let's keep after it. No, Kathy Wood has not moved up the list. Here's what Sean selected to put his portfolio in first. And he has got a kind of a playful selection there with GameStop. He really does believe that the business model is being evolved or mutated into an exciting opportunity. And if he's right, he's going to be very successful. But he also has Boston Beer, but a pretty good collection of stocks. And who can argue with the scoreboard?
But there have been days when GameStop stock has moved up 100% or moved down 50% in a single day, haven't there, Mark?
And not quite that much, but it feels like it some days. For sure.
It's certainly an up and down kind of a situation that rides. It doesn't appear to ride on the fundamentals the way that most of us tend to look at stocks.
Yep. So we'll have some fun watching that close out. So with that, let's go ahead and talk about our S-curves. Again, this is that traditional S-curve, which basically characterizes the life cycle of any company from embryonic birth up through development and into maturity, and in some cases decline. And we actually have a decline, at least it's a decline in progress that may be reversed or interrupted, but we've got one to talk about here today. So here's just a quick reminder. Here's Hershey. We insist that Hershey resides comfortably in the mature, and it'll probably be in the mature zone for quite some time to come. And it's a great example of up straight and parallel core holding. It's not going to set the world on fire with growth, but gosh darn it, it's pretty dependable would be my look on the company. And then here's just a reminder that even they face periodic challenges. Just a week ago, they said they might not be able to make all the Halloween candy they need to. They reversed that position just yesterday and said they're going to be fine. So just your Halloween reminder. All right, here's one I think we want to spend a little bit of time with, at least understanding with respect to the types of things that can happen to a company. And this is one that the audience may remember well, that Ken and I both picked this for the roundtable. It was a community favorite back in the 2010 timeframe. It seemed to be firing on all cylinders. And then one day Ken shows up and on a worldwide broadcast of our roundtable announced that the Apple Watch was going to wreck their business, and the investors all ran from this company. Just kidding. But that is basically at least part of what has happened to this company after 2014. We'll take a quick look at that. What are your thoughts on this picture, Ken? What's it call out and say to you?
Well, I think number one, Mark, is you have to decide how much time, how long a leash, if you will, are you going to give a company once it starts to exhibit characteristics that turn it from a growth company into a non-growth company. And when you brought this up a couple hours ago, my wife happens to be the secretary of one of our large investment clubs, and she does keep very complete notes. I know that we had owned Fossil during the period of 2013, 2014, 2012. We actually had bought it. And so I went back to try to look at the notes when we sold it as to what we were saying. And in fact, I went back a little bit before that. Could you click the next slide? I think that's the one I want to reference. 2 slides maybe, Mark. Right here, Len Douglas, one of our participants today, makes the point in May after that peak earnings number there. He makes the point that they've just reported a quarter number that is getting them hammered, and what is he missing? And at that same time, you can go back to their graph now, Mark. And at the same time, my investment club was noticing that 2015 itself was showing quarters that were coming in negative. And it didn't start out positive and go negative. It went from positive earnings in 2014 on all 4 quarters to starting the year out with slightly negative earnings and then seeing those just kind of accelerate. The club discussed in May, the same time Len was writing this post, the model club discussed that they had had a terrible quarter, and what were we going to do? Were we going to think about leaving the stock? Are we going to give them a couple more quarters? And we did not. We kind of got blinded, according to the notes that were taken that evening. We kind of got blinded to the idea that young people were wearing watches. They were wearing all kinds of watches, and many of them, a vast majority of them, in fact, were being manufactured by Fossil under different fashion names. We did note in the discussion that we had that the Apple Watch was just beginning to be marketed, and that there was talk coming out about competition to the Apple Watch, and talking about Fitbits and all the different types of variations on a watch that were just being dreamed about and maybe being marketed for the first time. Our notes suggest that we wanted to capture a capital loss if one existed, and so we would take up the idea of Fossil again at the November or December meeting of the club. And in December, we did take the issue up and we sold it. And the note suggests that we did, that we felt that while young people were still wearing watches, the tide had shifted from fashion to something that was going to be more productive, and that Fossil was going to have to either come up with watches that managed to compete with Apple's watch, or they were going to suffer some declines in what was going on in their sales. So we sold it. My other account, which is a personal account where I owned Fossil, my wife and I followed suit in January of that year. We had actually captured a capital gain. I'm sorry. Yes, yeah, I'm right. We had captured a capital gain in that stock, so we held it until after the new year, and then we sold it in January. The notes that were taken back in that time period proved to be very prescient. That the sales just continued to deteriorate. We had decided to give this company, which had always treated us well and where the management seemed to be doing a good job, we decided to give it 2 or 3 quarters, and we probably should have maybe even decided to give it only 1 or 2 rather than 2 or 3 quarters. But we did set a time frame for watching the stock and then leaving if the reverse was not happening in the direction of sales and especially of earnings. Notice that earnings declined much more quickly than sales declined. So all in all, it's a great example of doing what you have to do when a stock reaches a peak and no longer is a growth company. Luckily, we had nobody in the large club that had fallen in love with Fossil. That always complicates the situation. If you have somebody or 3 or 4 people that have fallen in love with a particular stock, because then it becomes almost impossible to move out of the stock. I'll tell you the tale of Chico's fashion some other time, but it was much bloodier than this reversal of fortune.
Yeah, I have a Chico story too we can save for another time. But one of the other things that just leaps off the page at me here is our belief that the stock price will follow earnings. Not always immediately, but I would defy anybody. In fact, if you've got anybody in your circle of investors that doesn't believe it, show them this. Just show this to them. I mean, even when it looked like they were going to recover and go positive, you get this. And then, as we often talk about, when a company like this then reverses and goes back negative into the red ink, the investing world will crush it. And when I say crush, I mean this company had already fallen from 140 down to 20-ish, or rebounded up to 20. The moment that this happened in 2018, 2019, it then proceeded to go from 30 down to less than 5. So, I mean, a company that had already lost 80% of its value lost another 90%, after that point. So again, I don't think I'm imagining things when I see that the earnings are basically, the stock price is basically tracking those earnings down there. So just something to keep in mind.
Well, and for those folks that are following RSI as if it's something magic, notice how late RSI was in predicting that you were going to have some issues with the stock. It doesn't begin to move below that 70 or that 30 line there until well into the middle of 2016. And by that time, you've already lost quite a bit of money. I think that our methods, which are to watch RSI but not to treat it as something holy, are really the best way to deal with any of these technical indicators, because I think that those of us that truly believe in growth investing understand that to be growing, you have to have earnings that keep growing. And when the earnings turn around, that's your signal to begin watching what's going on. And in fact, there was nothing mega going on. There was no closing down of factories. There was no supply chain issues. There was no shortages of materials. This was just a pure sales began to deteriorate. As sales deteriorated, so did earnings. And as earnings deteriorated, there went the stock price. Good, simple, better investing, manifest investing, good, simple language explained exactly what happened to this company.
Yeah, and on the technical analysis side, I will give one, at least an ounce of defense. This peak in RSI, which actually spiked above 90, which we regard as a timeout. Think about this as a potential sell consideration. And yeah, you had this still solid in place. This is all still solid in place, but note that the stock price never went above that point in time ever. So it's just something to think about. It triggers a thought of selling, and you basically had 3 years before the earnings turned and went
Exactly.
slowed down. So it's something to think
And
about.
then that buy signal right there was just it was just flat out wrong. You know, it was just absolutely in the wrong time in the wrong place. And you have to use your noodle when you're looking at some of these technical indicators, because they lag. They're not always working, and a lot of times they're actually not telling you the absolute truth.
Yeah, I think you need both. This is basically saying you need both. So you have this
Yep, I
situation
agree.
here, but you got to know that this is going on. So
Yep.
you can't operate without both, and maybe that's part of the message there too. All right, so on the manifest site, you can go back and look and see what we saw back at the time we were actually accumulating it for the roundtable. And then again, I do like this is a commercial, and Len Douglas is with us. I mean, this is the type of stuff that happens on the Manifest Investing Forum, where people like Len and Matt Spielman and Marie Frank and others, uh, many others, will actually flag something that anytime one of them puts out something like this, you can see I responded to it just a couple hours later with basically a seconding. I think there's something to be concerned about here. I only wish I had acted quicker at the roundtable, Ken. Sometimes we have to listen to our own advice, right?
That's the hardest thing in the world to learn, Mark, and the second hardest thing in the world to actually do.
All right, so let's talk a little bit. We'll spend just 5 or 10 minutes talking about Facebook, which is now Meta Platforms, and they're in a moment. They're definitely in a moment where, as you look to the right hand side of this page, things are flattening out on the sales side according to the expectations. So a little bit of a flatness. It's definitely below the longer term trend. Same is true with earnings. There's some weakness here, and even more importantly, the operating margins seems to be at least plateauing or trailing off, and we have this situation here with net margins, and that is principally related to the mix of some of the new stuff they're doing with the virtual reality stuff in combination, in a much higher order of combination, with the advertising element of their business. And we're sitting here looking at a company that, Value Line has these guys pegged for the mid 20s for net margin 5 years out. That's this number right here. And I don't know, if I'm a stock watcher for this company, I'm certifiably bothered by the fact that it's at 20 and it doesn't seem to be headed in the direction. We saw what just happened with Fossil, and it's something not to be taken too light or too. You want to heed that as a warning signal. And the same is true with the operating margin. Uh, is projected to be at lower levels than historical, and that may be a little bit beefy. So that suggests that those return forecasts might be a little bit on the high side.
I
So
guess I want to wave a flag also, Mark, to those people that that indicate that Facebook is just too big to go away. I think that I've lived and I've heard that song before with a number of companies that were new to a technology and that seemed to be dominating that technology, and then suddenly lost their dominance in a very relatively short amount of time. I guess that I'm speaking of AOL. I'm speaking of Compact Computer. I'm speaking of a number of tech companies that lost their way and were very quickly overrun by competition and are just footnotes to history right now. So I don't think the argument that Facebook is so large it's going to be around forever. I don't think that argument holds much water with my mind at least, because in my own lifetime I've seen these types of extremely large companies that were on the cutting edge at one point lose their edge and basically disappear.
Yeah, and I guess my thought would be if you own Facebook, Meta, or follow it for a club or whatever, I would pay attention to the things that are being said about their advertising model. Because again, I don't have a deep understanding of it, but if I were a stock watcher or shareholder, I would attempt to. Um, the changes over at Apple with respect to how they deal with advertising and some of the compensation measures have changed. And the same is true with Google. And we did talk about this a little bit in the Life After Google sessions from 2 years ago. And there's a chance that that is manifesting in some way here. And if that is true, Ken said the magic word, the competition and some of the pressures will drive this stuff that you see here perhaps even further down than currently is. Yeah, they have 3 billion users. I get that. But those pressures are real. And again, I think I would strive to try to understand them and keep track of them. I mean, from a standpoint of saying, these guys could survive and really do extremely well. They have no debt. They have $40 billion in their checkbook with no debt. Now they have some liabilities, but there's no debt here. Okay, so that's a feather in their cap. They are trading very close to their 52-week low, which we saw with Fossil could be misleading. The 3 to 5 year forecast from Value Line is very favorable, that you see here. And Morningstar continues to be favorable, although they have reduced their fair value estimate with their most recent research, but it's still fairly attractive. And again, I would look at it from that standpoint. Here's a look at it again. Elevated numbers here, most likely. They could be true, but they seem to be a bit elevated to me. And you can see that Morningstar is using 12% for the growth expectations. And you see a pretty big number here that's vastly different than that. And then this note up here is what I'm referring to with develop an understanding of, what changes in that business model with respect to advertising could possibly do to this company.
I'm going to make a point for Matt Spielman, Mark, who writes on our question box here that we have to understand that Facebook's competitors are much broader than you might first imagine. Netflix is developing a model where they're going to have for pay, besides a broadcast that will be commercial free, they're going to put a model right with the Netflix brand that will have commercials in it. And those commercials need subject area. And Matt is making the point that many companies are probably budgeting money right now for that Netflix portion of advertising, thinking that it will be at least as profitable as some of the, and as useful as some of the things, money they're spending on Facebook. I want to make a secondary point. I hope I get the name right. Sheryl Sandberg, is that the right first and last name, Mark?
Yes, should be.
I'm saying to myself, How valuable was she really to all that Facebook had done and become? And is it coincidence that she leaves as the company announces it's going to completely change direction? Or is it reality? Or am I creating a what do you call them when we're just making up things to fit into reality? Is it all
That's
uh, uh,
cognitive bias, right?
well, perhaps, but if she was as important as I think she was, and if she had as much influence as I think she did, I'm wondering if her loss to the company isn't a little bit more uh, difficult for Mr. Zuckerberg to deal with than he might be letting on. Uh,
As you know, I sent you some playful memes along that time, but seriously, that she was a senior level executive and apparently one heck of a leader, and that is something that has to be compensated for. At least you have to be aware of it as a shareholder.
Well, and all the gossip points to the fact that she played the role of human being and allowed him to play the role of somebody other than a human being whenever he chose to. So, I mean, that's as nasty as I'm going to get with it. But uh, is everything in place with the leadership that will lead me to believe that they're going to be able to pull off this huge change in this giant company? I'm not sold on that. And I will tell you that I have taken Meta out of all of my portfolios that I'm involved with, except for one. We still hold it in the family club because the family club still thinks this is one heck of a company, and I don't want to upset my family. So.
Well, I do note that it's dropped out of the manifest 40, and I'm not sure even as people adjust their dashboards if it's going to recover from that. And I did want to make one last point here. As many of you know, my wife insisted that we buy shares at the IPO of this company, and I mean, we love the company for sharing pictures of our grandsons and all that stuff. That's all still true, but we actually did buy in at the IPO, and it went down. So I said, I told you not to do it, but you did it anyhow. And she said, just be patient, honey. Um, and obviously she was right again, as we enjoyed all of this. And then I want to point out that we talked about this a couple years ago, and at the risk of this becoming an I told you session, we talked right around the price of $200 per share about what you could do with a trailing stop limit order. And this is an example of one that we use. We put a trailing stop limit order on it. It was Facebook back at that time at around $200, ended up selling it at about $320. And I want you to notice where that would have been. I don't remember. It was probably this one, probably when it dipped back into this range right here. But um, obviously selling it at 320. I have no idea what the future holds for this company, but again, it can be the type of thing which protects you from a Roman candle incident with a company like AOL or some of the other companies that Ken mentioned. And again, I don't know what these guys are going to do going forward, but we did use a trailing stop limit order to exit at a very nice price compared to the IPO, and we're okay with that.
I wonder, Mark, if you would have cut off the top banner on this company, that cut off the banner that includes the name of the company and the present price and PE and all those things, and just allowed a look at some of the data. I wonder what people would have said about that circled data that you have, the high projection at 42% annualized and the low projection at 28% annualized. My first reaction would have been, wow, that's just way too good to be true. Way too good to be true.
Yeah, and I agree. It's another good point to make. Part of that is driven by this number right here, and that's at 25. You go back to this page, you'll see that the analyst consensus is more like this. Okay, so you're seeing 18 times earnings here in this model, and I look at this picture and I see more 18 than 25. Just as one example of a point which can induce those numbers that Ken's complaining about in this box right here.
Yeah. Yeah.
So again, it's just bringing some of the reality. What's the projected return on value? Again, that this 25 matches up pretty well with this 21. And again, keep in mind that that's at a price to earnings ratio of 18. So you give it a 25, now you're looking at 25 versus 33 or 35. All right, good stuff. Anything else on that, Ken?
Mark, we're getting a question from Yuval, and he says, where would you find the price to sales ratio? And if you could show him where you would find it, how do we view it? What is it useful for, or is it useful?
Well, we sometimes will use price to sales ratio for early stage companies, and it can certainly be used for any company along the line. It's actually fairly rarely used for more mature companies, but you can calculate it just simply by taking the sales per share, which is on the value line page, and dividing that by it's obviously the recent price divided by the sales per share, and you'll get a price to sales ratio. And you basically would want to trend that over time to reach any conclusions. One of the places that it is used for many companies, we've talked about this before, here it is, when companies don't have earnings, early stage, O'Shaughnessy and Ken Fisher talk about this, so you can actually use the price to sales ratio pre-break even. I think the projected return on value is much better. That's just a personal opinion. But you can actually track price to sales ratio for companies. And you can continue to use it throughout the process. I just think that, through the life cycle, I just think that some of the others are more telling. Again, coming back to this picture of, as we pointed out, for fossil, price follows earnings. And it does follow sales ultimately, too, judging by that green line up at the top, but it really follows earnings, the stock price. Hopefully that's a fairly decent answer. We could look closer at that at a future session. All right. So let's go ahead and close down. We're coming up on an hour. Thank you, Ken, for InMode.
You're welcome.
And I wish you'd have bought a lottery ticket for me last week, because that's pretty good. You can slap me for Ranpak, but our two portfolios are actually they're actually closing the gap with the traditional Wilshire 5000 represented by the VTI ETF. The bear is still there because the Russell 2000 growth is still below 1600. So it's still operating in bear market territory. The Wilshire 5000 in our two portfolios, and these are the companies in the active portfolio that are on display here. The active portfolio, they are at least closing on the Wilshire 5000, and we continue to hold out hope between now and Halloween. Kim did want to point out that her favorite Southern Missouri Bancorp actually turned in some pretty good numbers too. And Matt would like to point out that he's been right all along about Green Brick Partners.
And I'll point out that while I gave you InMode to put into this portfolio, I didn't buy a single share of it myself. So
I wish I could say I did. All right, so we continue to hold out hope. This one continues to turn a little more green than it was, and we'd certainly like to see that trend continue. So with that, let's go ahead and remind that we archive all of these presentations on YouTube under the Manifest Investing channel, including our roundtables, all of the bull sessions, and some of our special educational sessions. And if you just go there, you can take a look at the stuff that is available there on videos. They go back several years. You can go back and see when Ken talked about fossil as a good thing and fossil as something that needed to be a head-scratching moment back in early 2015. You can actually hear it again. We would have greatly appreciated if you would subscribe so that you can be notified anytime that new content is added to the page. And with that, this is from Susan Michelik. It's actually a commercial one, but wow, what a picture of the Lake Michigan facing west, somewhere up near Door County, I believe. And I think we might need to put this on our list of places to visit too, Ken, along with Sweden and Punxsutawney.
Okay.
The list is growing.
All right.
All right. Any other thoughts? I did, in the appendix, I did keep our global stuff. We'll be spending more time with that as soon as I get a spare minute to try to add some quality companies to the list.
Well, I was able to keep up with the questions and comments today, Mark, so we can say goodbye to everybody and see you next Tuesday. It'll be a short hiatus this time, just from now until next Tuesday.
Okay. Thanks, everybody. Let us know if you have any hot stock tips out there to study.
Good afternoon, folks. Good afternoon.